Welcome to this market update with Axial Capital Partners. I'm Rodri Llewellyn, the Director of Axial, and since our last update a couple of weeks ago, the VC and SME finance markets have continued to be as fluid as ever, positively in many respects. In terms of the investment houses, there's certainly policy review that will impact the rest of 2020, if not beyond, looking at what the investment criteria and risk profiling is going to look like in what is a new marketplace. In terms of debt funding, not dissimilar. There's constant review there of underwriting procedures. The overriding objective, at least in the short term, is to really pare back risk, not to be overexposed even on a secured debt facility. So we're in regular discussion to see where that's going. But on the positive side, there is still that money in the markets, and we're still actively drawing down on money across both the investment and the debt space. We've continued to see client-side activity not dissimilar to usual, really. Many businesses are carrying on, and they're looking beyond the current environment. So that's certainly been very positive as well. Not without some lack of momentum against headwinds of inaccessibility, as we touched on in the last recording, in respect of such as buyouts, to be able to send in the auditors to review financials, to take a transaction through. There's an accessibility issue there in terms of a secured debt facility valuing assets. Again, you need to get in there. You need to be able to value an asset. And how that is done is, again, quite fluid. Things are going in the right direction. It may just be slower than we would like to see. At the same time, a contingent of funding houses are beginning to review deals again. In some cases, under the pre-existing investment criteria, others are being more opportunistic in their approach. If the fundamentals are correct and if the security is there, then we're seeing a proactive approach to getting money out the door through a number of channels. In terms of the outlook, it's varied the way the market is currently. In the corporate space, it's clear that early stage funding throughout the venture capital spectrum is going to be different to what we have seen over the past 12 to 24 months, through the rest of this year certainly, and whether it goes beyond for the reasons that I mentioned before. In terms of debt, that's not going to be dissimilar either. It's going to be a case of when we see the current actions, the current paring back of risk, when we see that changing. In terms of M&A, there's certainly more activity there. Acquisition-wise, we are working with a number of clients on what would be a typical buy and build approach. Now is a time to take market share. It's a good opportunity for a land grab for many of those businesses. And again, if the fundamentals are there, we are seeing quite a positive response from the funding markets to be able to see those transactions through. The market signals are something that we're keeping an eye on to spot the moments where a degree of clarity presents itself. The nature of the market's really comprised of two economies: the financial economy, the fiscal economy, which is largely at the moment government directed, and the real economy, which is where businesses operate within the confines, within the parameters of that fiscal economy. And one lags the other. The real economy, what businesses can actually do, is very much dictated by those fiscal parameters that are set. And that's what, as everybody else is, we are watching to see where we end up in terms of government policy position. So where the real economy goes is something we're not going to clearly see for some months ahead, and and that's really where the cycle of policy review in investment houses and also in debt providers is going to take time to see where it comes out in the wash. On the real estate side of the business, we're also seeing client activity carrying on. There's the two elements there, I suppose. There are those who are partway through projects right now. They are carrying on. They're seeing their supply chains freeing up again. They're seeing activity continue. Teams are going back to work. A lot of the major house builders went back to work last week and this week. New starts, that's where there may be a lag, and we'll monitor that over the coming weeks and months. But we're certainly seeing interest to originate new deals, both on the client side and on the funding side. The uncertainty remains across all segments of the market, of course, as well as operational uncertainty for most businesses. We're advising clients at the moment to look at where value or opportunity presents itself. Going back to what I was saying there about looking at acquisition opportunities, whether within the existing market or taking businesses out of administration, which is something, of course, we're seeing happening more and more frequently now, where we're looking at new cases daily. Supply chains, as I mentioned before, are beginning to ease out of their gridlock, not just on the real estate side, but across the board, really, and that's allowing a degree of momentum to build again. So productivity is moving. It's certainly less absolute, that gridlock that we saw some weeks ago, and we're seeing that across client businesses and within our own portfolio as well. And where that's going to become more relevant is when we draw funds into those businesses. It's a case of supply chains allowing them to move again. What does a new normal look like? And that's something that we're doing with a number of clients right now, is really understanding how they're going to operate in what will be essentially a 2020 supply chain market. We don't see restrictions once they move in the next 4 to 8 weeks. We don't necessarily expect that there's going to be a drastic change from that, at least through the rest of this year. So it's how businesses will adapt to that. And a good example is events businesses, 3 of which we know quite well, 1 of which in our own portfolio. And for them, it's a move to online and more virtual delivery to their clients. Those sorts of adaptations are going to reshape how they will look going forward. And again, as I said, that's going to dictate how we structure investments and how we draw the funding into those businesses. But that's not just us looking at that. That's how investment houses and how institutional funding lines are also viewing prospects going forward. So that's going to be part of the new normal, basically. It won't simply be those businesses that I've mentioned that are going to adapt. This is going to be something that we expect to see much more of, basically, and that's where those businesses could ultimately deliver more value for their investors by being forced to shift into the digital space, which we all know is where there's broader value and where most industries are having to either move to or bring on board much more of the digital assets for them to be able to expand their markets and keep their market share. So we do expect to see that continuing going forward. Essentially, it comes back to, if that creates the right fundamentals, lets those businesses maintain the right fundamentals, that's where we're going to keep placing capital into them. So as ever, we'll continue to make updates available as we see movements in the market. And we thank you again for watching.